The first type of adjusting entry that we will learn is accrued revenues. Accrued revenues are revenues that are earned but not yet received in cash. Examples of accrued revenues are rent, interest, and services performed. Here's a timeline that I created to give you a visual of this type of entry. I have January here at the beginning and December at the end. Usually the timeline for these transactions are not this long, but I wanted to over-exaggerate the timeline in order to give you a better understanding of this topic. First comes the action, which would be making the sale. We would either sell the product or perform the service. This is when we recognize revenue. At a later date, we will receive the cash. When it comes to adjusting entries, the revenue or expense recognition is the most important part, not the cash part. The adjusting entry will involve debiting a receivable account and crediting a revenue account. We are debiting a receivable account to show that we are owed money. We are crediting a revenue account so that the revenue is included on our books for this time period. For all of the adjusting entries that we will be journalizing, it will involve either a revenue account or an expense account, no cash accounts. The next accrual is accrued expenses. These are costs or expenses incurred that are unpaid. We did this entry last chapter as well. We use an expense and will pay it later. Examples include taxes, interest, and salaries. Here is the exaggerated timeline again. We first use the expense and thus will record the adjusting entry here. Later, we will pay it. Remember, we are concerned with either the revenue or expense entry, not the cash entry. The adjusting entry will involve debiting an expense account and crediting a liability account. We are debiting the expense account to record it as an expense during this time period. And we are crediting a liability account because we now owe that debt and will need to pay it in the future.